All right, guys, welcome back to the course, Investing 101. This is lesson 3. We're talking about risk and return. All right, by the end of this lesson, I want you to have a clear understanding of the risk and return trade-off in investing. I want you to understand how to assess your risk tolerance and understand the significance of diversification in managing risk. One of the things I want you to understand is within investing, you have to understand that there is a trade-off, right? You have to give up something you want for something you want more. And in investing, it is the risk and return trade-off. There is no such thing as investing without risk. No one will let you or allow you to invest and ultimately take no risk on your money. So what we talked about in the last lesson was how the risk and return trade-off can vary between different investment vehicles, but you have to understand that first and foremost, there is a risk and return trade-off. First of all, the risk and return trade-off is fundamental to investing, and the higher potential returns you have, usually it's associated with a higher level of risk. Not always, but a fair way to understand risk and return is that all things being equal, the higher the return associated with an investment would mean the higher level of risk that you are taking in that investment, right? Basically, if you are going to get a big payoff, then you need some level of risk to your initial principal, all right? So that's what we have to understand, all right? And so we're going to talk about some examples, right? We're going to talk about what low risk investments are, low return investments are, and then talk about what high risk investments are and high return investments are. All right, just to give you some examples, right? So a low risk investment would be something like a money market account. Now, a money market account is low risk because that's the way they manage the fund, the asset, right? So a money market fund would be managed to a point that you will not lose money, right? The manager of that fund is making sure that you have daily liquidity and short-term investments in that structure so that the values don't fluctuate that much. But a money market is going to return very low level returns, which is to be expected. Now, high risk compared to, say, a money market fund would be like a stock fund. If you want to own technology stocks, let's say. Well, as technology stocks go and as the market cycle goes, technology stocks can go up and down pretty quickly, pretty volatilely, pretty dramatically. Take a stock like Tesla, where we see dramatic swings in its value. That's to be expected in a stock or a stock fund. So it's going to be very different than what you experience in a money market fund, but the return potential that you have in a stock fund is going to be great. It's going to be outsized returns if your bet is correct, right? If your assumptions, your research, your investment is correct, then you will be compensated for that in a great way. Rather, there's no such real thing about being correct or making the right decision on a money market fund. It's a money market fund, right? So you don't really, there's nothing to it. It's just a enhanced cash vehicle, if you will. So it's important to understand how that risk and return plays into your ultimate investment success and outcomes, right? How the risk and return trade-off influences your returns, your outcomes, your experience, if you will, in your investment account. All right. So what I want to talk about today is helping you assess the level of risk that you are willing to take in an investment. All right. So risk and return are related, and now you have to determine the level of risk that you are willing to take with your money in a particular investment. And for novice investors, this is actually one of the more difficult aspects of investing, because on its face, all funds look the same. And what's the difference between that stock and this stock? And especially when the market is going up, you feel, what's the difference between stocks, right? Big differences as you get into understanding your risk tolerance, the actual experience of investors in a fund or a name like a stock, and what you're comfortable with as far as your goals and the probability of you meeting and reaching those goals. So what I want to do is have some time to help you learn how to assess your risk tolerance. And if you need more help, I'm happy to help you offline. If you're a member of the course, please feel free to ask your classmates, and we will then answer the questions that seem to be common amongst our group. So what I want you to do is think about the factors that influence risk tolerance, right? So what influences risk tolerance, right? Think about life in general. When are you more likely to want to take risk at large, any risk, right? Flying on a plane, jumping out of a plane, right? Going on a vacation with people you don't know, or going somewhere where you're not comfortable, you don't know what's happening, or any level of risk that you might be willing to take. When are you more likely to want to take that risk? It's probably a function of your age, right? And as you get older and you've accumulated more things and you have more to lose, you're less likely to want to take risks. All right? What about the financial goals that you have, right? If you have financial goals that are pretty in stone, take like an endowment, all right? Or take, say, a trust fund or insurance. You want to make sure that you are taking the appropriate level of risk for the commitment that you've made, right? If you make a commitment to a disabled veteran that you will be able to pay them $500 a week, and you have a pot of money to invest, that promise is a promise that cannot be broken, right? You cannot come up short. So you have to invest in a way that is prudent, but also conservative enough to get you to where you're going in a high probability way. So you have to understand that as you get older, age, what are your goals and what are your circumstances are all going to start to influence how you view risk and how much risk you're willing to take with your assets that you've worked hard for. So you have to remember, when you're investing this money, this is your money. You can do whatever you'd like to do with it. And if it's some money that you've already prudently put aside, you're certainly going to want to prudently invest it, all right? So that's something that you can start to understand about yourself, about your risk tolerance, and about your preferences. Now, what we also want to talk about is types of risks, types of investment risk. What risks are out there, right? Oh, the market goes up all the time, no risk. Well, that's not true, first of all. And over time, it does, but you don't know what points you are getting in, what points you're getting out. And you have to be able to assess these things. Now, what types of risk are there? First of all, let's start with the basic risk that we have, right? We have investment risk, right? There's risk to investment, like big level risk, systemic risk, or market risk. The risk of investing in the markets is a risk, right? Then, so that being said, and what is that influenced by? Of course, it is influenced by productivity levels, economic factors, big level macro things. If the country starts doing poorly, well, investments aren't going to do well. We have to understand it in that way. Now, what are the specific risk or sector-based risk or individual risk that you can take on in a name? Well, what about credit risk, right? You could invest in a company that has a low credit rating, and well, you are going to be investing in a lower quality company than someone or some company that has a higher credit rating. Interest rate risk. What if you invest in a bond or even a stock that's very sensitive to changes in interest rates, right? Let's take a business that relies heavily on loans or access to capital. Well, as interest rates rise, is going to affect that business much more than a business that doesn't have such a dependency on interest rates and the fluctuations, right? What about liquidity risks? We have risks that some companies need a lot of cash and they need a lot of cash on hand. And what if the situation happens where liquidity dries up? Well, that business is not going to be able to function at the levels that it used to, which is going to depress its performance, which you're going to then experience that as a loss of value in your money as you own a piece of that company. So you have to understand a lot of these things, and that's what we're here for today. I know I threw a lot at you just in the opening, but these are the things that we're going to be talking about in this lesson and as we unpack risk and return. So I want you to understand how these risks have to be assessed and quantified and then acted on as we build a investment portfolio for you that is hopefully globally diversified and will meet your objectives for your financial goals, right? So think about it in that way, and then we start thinking about risk and how to manage that risk, right? And how to mitigate that risk, right? Risk mitigation and risk management are similar, but they're not the same thing. One way to think about risk management is diversification. Now, what does diversification mean?